Hey everybody, it's Ken and Danille.
Hello.
And I'm here with the famous Bobby Ball.
Hi.
What's happening, Bobby?
How you doing?
So for some of you, you may know that Bobby works for MC, works for me. I wanted you on today because, things are changing in the commercial real estate world a lot, right? Cap rates are up, interest rates are up, expenses are up, and rents are flattening. So values are down. But you, my friend, have seen all this before, right?
Right.
If you're new to the game in the last 5 or 6 years, you're freaking out, right?
Mhm.
Right now.
Right.
But guys like us, we're like, whatever, next, right?
Patience.
Yeah. So let's talk about like the S&L crisis in '08, because these cycles we've seen, right?
Yeah.
Yeah. So can you walk us through, kind of what you see the life cycle of a commercial real estate deal?
There's a lot of deals that are stressed, but they're not distressed.
Right.
And I think right now a lot of buyers are looking for the distressed deals. The media is really hyping it all up. It's really overblown about the level of distress.
Yep.
And multifamily, the reason why I like multifamily is because everybody needs a roof over their head. And that was explained to me early on. And that's why I didn't go into office or retail or industrial. So multifamily, the fundamentals are still really strong. And there's debt out there. Fannie Mae and Freddie Mac and other lenders will lend on it. In my view, there's just not the level of distress yet, but it's coming. Maybe there's still debt out there and there's still a ton of buyers waiting with dry powder to pick up these deals. Like in '08, it was a little different. '07, remember the condo conversion?
Yeah, I do.
I know you had them. So we had a lot of broken condo deals in '06, '07, '08. The multifamily deals started happening probably around '08, '09. More lenders came to grips with the reality. And the reality right now, I think, is let's just pretend and extend. And let's extend out these multifamily borrowers, the sponsors, for a while. And I think that's what's going to happen is there's going to be more extensions. We're just going to have to take a wait and see type mentality because a lot of deals didn't materialize, this year.
Right.
A lot of owners just pulled their properties off the market because they didn't hit the bogey on the price.
So when you say extend, can you explain that to the audience? Because not everybody knows what that means.
Sure. So
it's an insider term.
On the left, then kick the can down the road.
Yeah.
Lenders, if they're not being paid on the debt service, they're going to extend out the loans or do a loan modification on the interest rates. So that's what I think is going to happen now for the foreseeable future. I mean, there's been a lot of sponsors right now that are working with their lenders on extending out the loan maturities and then also modifying the interest rates.
They don't want the properties back.
So they don't want it back.
When they extend out the loan, does that make the monthly payment less, or is it people not paying and they're just putting the payments on the back end? Or
so the monthly payment will change based on the interest rate, depending on the loan modification.
The problem is the interest rates are higher.
Yeah, the interest rates are higher. So you've got some groups going into more of the debt market.
Yep.
They want to be a debt provider and not be an equity provider. So they're looking at maybe like a 9 or 10% interest rate now because interest rates have gone up. And that's one of the challenges that we're seeing. I mean, Freddie Mac now is at about 6.5%.
Yeah.
Or 6.25%.
Which is almost double.
Which is double.
Couple of
right.
years. Yeah.
So all the interest rates have changed. They're up, call it 250 to 350 basis points.
so you see these banks more working with the lenders as of right now and extending their loans so that they can afford the payment.
Sure. And like Ken said, the lenders don't want the properties back because then they're going to have to go through foreclosure or bankruptcy, and that's costly. And then they're going to find that, buyers really want to steal. They want to bargain.
That's where distress.
And that's the distress.
You said it perfect at the beginning. You said there's stress and there's distress.
Right.
And we're not quite at distress.
So do you think that what would change the course of these banks? Like what would make them say, listen, we're not going to extend loans anymore. We just want to foreclose on this thing and get it off of our books?
It will have to be total capitulation on the side of the borrower. The sponsor would have to totally capitulate and say, throw their hands up in the air. No moss. I don't want to go through this anymore. I don't want to throw, good money after bad, and just take it off my hands. And then the lenders will go through the foreclosure proceedings, find a receiver, and then go through receivership, and then they'll probably hire a broker to sell it at probably 70% of the loan value.
I was on a call last night, a Zoom call with 70 people. It was pretty interesting because there was a lot of lenders on there. There's a lot of LPs on there, GPs, syndicators, et cetera. And the big question was, what do we do? We're all getting cash called. So that's actually what's happening. That, they're running out of money, or they've run out of money, and they're trying to figure out a way to buy a rate cap or to have enough money to continue to run the buildings, et cetera, et cetera, et cetera. And so there's this kind of short-term problem. And so the real issue is, how long is that money going to last them? Because to Bobby's point, the property might not be worth the loan. It's possible.
It's possible. And then, some of these properties that are on the market now, maybe, the buyers are saying, what am I going to be able to change that you haven't been able to, execute? So if you're trying to execute, a renovation plan, and then you weren't hitting your premiums or, other issues. But what I'm seeing now, though, is, there's still a market for well-located properties. And these lenders today, like the special servicers, for example, they're not as busy because there aren't as many properties being kicked into.
Multifamily, so far, our occupancies are high.
Yeah.
And while rents are down, they're not, they're just decelerating from what they were. Now we're underwriting at 2 or 3%, which is about what they are, right?
Right.
Yeah. So it's not that the multifamily business is really in jeopardy. It's that the debt costs and the expenses on those projects have gone up a lot.
And the expiring rate caps.
That's right. And the expiring rate caps. So that's what's happened.
But, I think the lenders are going to work with everybody. And,
I sure hope they do.
And I hope they do too.
Well, if you don't, you're going to have like a major kind of crisis, right?
Right.
There is dry powder to pick up deals. So on that level, right, it's not like nobody would buy them. But, you're still going to have mass disruption if a bunch of buildings go back to the bank and a bunch of people lose their money. It'd be like kind of like 2008 with the housing market, but in commercial real estate.
So what I'm seeing now is most of the deals that are happening in transaction volume is down probably 80 to 90%.
That's
okay.
Because
in multifamily, I'm just talking multifamily. Office,
it doesn't exist.
It doesn't exist. So on the multifamily side, transaction volume is way down. All the brokers are doing broker opinion and values, and they're asking the owners if they even want to see them because the prices are coming in a lot lower than what they're anticipating. However, most of the projects that I'm seeing now are merchant builders that are selling brand new construction.
Yep.
Or owners like MC that sold a property that have owned it for, say, 18 years and want to recycle capital. Other owners, like Western Wealth is selling, or Cortland, others are selling. Maybe it's expenses, that they're just exiting because of higher expenses.
But what about people that are going, even though you're saying the banks are going to work with people, are you still thinking there's going to be a wave of defaults?
Maybe next year.
I think so.
Maybe next year.
2024.
Because are those owners or sponsors going to be able to refinance? Is there going to be a market for them?
Well, let's talk about interest rates.
I was going to say you would only refinance if rates go down, right?
Well, there'll be other solutions probably. Maybe.
Like
so
what?
Rescue capital. So where, for example, I know a company that will come in and offer 15% pref equity, and they'll basically take over the deal on the management side, and they'll get the asset management, and they'll bring capital to the deal. So basically they're writing a check to refinance the current loan.
I see. To make the payments smaller, not necessarily the
to refinance it.
Got it.
Into more of an attractive loan situation.
So you have to navigate through all that stuff, but it all has to do. It's a good question, like whether it's rescue capital, which could come from internal. You could actually go out to your LPs or and try to raise more money. And the question would be, Bobby nailed it, is if the asset's a good asset and if it's well located and it's close. If it's close, I would probably do it. Right?
Yeah. I would do it.
Yeah.
I would do it because the fundamentals are so strong for us, for multifamily. The fundamentals are still strong and there's buyers out there for it. If it was an office building and it was vacant and everybody was working from home,
then that's exactly right. What's the plan on the property? That's why when you said
vacant retail next to an office building that doesn't have any employees in there.
Yep. If you have a retail center with and the grocery store left, you probably don't want to fund an LP, or you're in an office building that's 50% vacant. You probably don't want to do it.
And then the preferred food groups are multifamily and industrial.
Right.
Those are performing the best.
Those are different, because
and you would want to save that. I feel strongly that you'd want to save it.
Yeah.
So because in the coming years, the cost of construction, the cost of debt, the construction loans are at 8% right now. There's going to be what, 2025 to 2026 to 2027.
No new deals.
No new construction.
We have no supply coming.
You're really not seeing any new construction unless they're finishing right now.
Yeah, exactly.
So they're
wrapping up
there. So what that's going to do is going to create, there's going to be a lot of demand, no supply. It's going to make prices and rents run again. Bobby's right. And 25, 26, even potentially 27. So that's why I say stay alive to 25.
That's right.
And if you can, then whatever you have is going to be worth, in my opinion, more. It should be worth more based on basic supply and demand.
Well, thanks, Bobby.
Bobby, for questions, as always. Thank you. As always, thanks for the wisdom.